Hello, very good morning to all. I hope that you guys have a great May Day break. Welcome to today's Daily Dose of Market Insights. I'm Kelvin Wong here again. Very good morning. Today will be Thursday, a brand new month, the second day of a brand new month of May, 2nd of May, 2024. So before we start today's Daily Dose of Market Insights, let's have a quick look at the disclaimers first. All right. Leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exit deposits. This presentation is not an offer or solicitation to buy or sell, no financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection, excuse me, in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. Okay, so we have a fair bit of ground to cover today. Why? Because of yesterday's important risk event, which is the exposed Fed FOMC meeting, as well as Fed Powell presser, which gave an indication of what is to expect. Excuse me, pardon me, a bad throat. What is to expect of the Federal Reserve monetary policy going forward and their impact on the various cross asset classes. All right, so before we start, let's have a quick look of what has taken shape yesterday in terms of Fed Chair Powell press conference and the FOMC meeting. So during the FOMC meeting, no change. Market is came in with market expectation, no rate hike or rate cut. So still maintain the that Fed funds rate at that 5.25% to 5%. So that has been around since last year. Okay, last year July. So if we were to look at the press conference of what has taken shape yesterday, okay, let me expand my screen. So the tonality of Fed Chair Powell, we call it conference, is not as hawkish as feared. And he did stress during the press conference that it's unlikely the next Fed move will be a rate hike. All right, but he also did acknowledge that they are facing a challenge in this ongoing sticky and elevated inflationary trend environment in the US. And with that, he also did fear that I will not to stress the word fear. There is actually a potential liquidity crunch that may come into the US stock market or the US market. So what do I mean by that liquidity crunch? Okay, let me share with you and one of this chart before I jump back to here again, because all these are interrelated. Okay, so this is a proxy of US net liquidity, we call it trend. Okay, let me share with you. Okay, so for those who join us in our longer term, we call it a quarterly update or outlook, I did share this chart with you all. So this is more of a longer term picture. Okay, so what you see on my screen over here is you see three lines on the top, S&P 500 and the NASDAQ 100 in red and blue, and there's this little green line here, and this green line actually track very closely with the movement of the S&P and the NASDAQ 100. And mind you, this is not an intraday chart, it's a weekly chart, so it's more of a longer time frame in terms of major trend horizon. Talk about multi-month. And what we could see over here is that in the last few weeks since the start of early February, the green line, which represents US net liquidity, is actually pointing downwards. So if this tree line is to track in direct correlation, that means there will be actually downside pressure coming into the S&P 500 and the NASDAQ 100, which has already taken shape since March this year. All right, so the S&P actually fall down, but it actually lags slightly behind the net liquidity, the green line that I shared with you. So what is this net liquidity? So this net liquidity is actually taking into account of the Fed balance sheet. So Fed balance sheet is, you know that the last couple of years, Fed balance sheet actually expanded. Why? Because of quantitative easing. So now the Fed is no longer doing quantitative easing, they are doing quantitative tightening. That means they're no longer buying bonds. That minus off the US Treasury General Account. So this US Treasury General Account is like a checking account of the US government, where if this account is rising, that means they actually need funding requirement. And minus off the Federal Reserve repo facility. So what's this Federal Reserve repo facility? Is actually excess fund parked by market participant with the Fed. All right, so let's say if the market participant, or especially being utilized by market uh, fund managers who manage money market funds, very short-term funds. Let's say they receive a lot of funding from market participants to invest, because they will actually use this excess fund to invest in T-bills, short-term treasury debts. So if they have very surplus of excess cash, they will actually park with the Fed. Why? Because the Fed itself is considered as a risk-free, we call it a funding vault. Very unlikely the Fed will go bankrupt, so they park their money there. So what we could see over here is that since May last year and all the way down to September, and since the start of December last year, there was actually a huge drawdown in this reserve repo facility. And this huge drawdown in this reserve repo facility is being used to actually fund the US Treasury general account. Why? Because you see there's a reverse up move here on the US Treasury account since late December last year all the way up to last week. There was an increase of 43%. And it looks like this trending US Treasury account up move is going to trend higher. Why? Because on Monday itself, the US Treasury actually released their latest funding requirement. That means they actually expect this quarter funding, April, May, June, to be much higher than the previous one that is projected in January this year. So that's already covered in a Tuesday daily dose of market insight. You guys could actually take a look and review that again. So we know if there's a further uptick in this US Treasury general account due to a funding environment, a higher funding requirement, pardon me, the reserve repo facility got to draw down faster to cover this funding requirement. But unfortunately, the reserve repo facility right now is coming very close to zero. Okay, over here is declining and coming very close to zero. Once it hit zero over here, the next step over here to actually fund this uptick in US Treasury general account will come from the bank's reserve. All right. So when it comes to the bank reserve, there will be a further drawdown in the net liquidity system. Why? Because the US federal balance sheet is no longer funding this uptick in the general account because they're not buying bonds anymore. So buying of bonds will come from the private sector instead, which is from the banks. So that is what we call the bank's excess reserve parked with the Fed. So once that's happened, that means there will be a further net liquidity drawdown. So to prevent this further net liquidity drawdown, it will not reverse up. Because why? Because the Federal Reserve repo facility coming back to zero. In order to reverse up over here, there got to be QE. But the Fed is not doing QE. So to prevent the steepening pace of this net liquidity on the downside, the Fed actually engaged in what I call QT tempering. Okay, so the Fed will slow down the pace of balance sheet runoff starting in June, because they know that there will be a ongoing steep pace of net liquidity declining, as you saw on my screen over here. So to prevent the pace of declining too much, they will actually reduce it by QT tempering. Okay, they will not do QE anymore. So what they do over here is that, let me share with you what do I mean by, yeah, over here. So the Fed will allow matured treasury without being reinvested back into the financial system to 25 billion from 60 billion. So instead of running off 60 billion every month, they will reduce it to 25 billion. So that actually causes a bit of what I call positiveness into the US stock market. Why? Because the US stock market initially rallied up, okay, right at 2:30 p.m. when Powell is speaking, all right, on that. So there was a sharp rally up on the US stock market. This was S&P, hit a intraday high at around 5,090 level. Then thereafter, it plummeted all the way down to close near the close at the end of the US session. So overall, right, there is still this ongoing negative sentiment in the US market. Later I explain to you all why. Okay, because there is actually a longer term technical factor that is supporting further potential downside on the US stock market from a longer term horizon. That means we're talking about our medium term horizon, multi-week to potentially multi-month. All right. So overall, the S&P 500 ended the session negative 3.4%. Despite that initial rally, it can maintain during Fed Chair Powell press conference that is deemed to be less hawkish. Nasdaq 100 down negative 0.7%, which was the worst underperforming major stock indices yesterday. The Dow Jones Industrial Average slightly above positive 0.23%, the Russell 2000 positive 0.3%. Okay, so if you look at the trajectory of the Nasdaq 100, very similar as well. All right, even though the Dow Jones Industrial Average actually outperformed with a slight gain of positive 0.23%, you look at it over here is that the intraday gain, the highest intraday watermark at around 3,800 also got watered down and closed near the low of the day. All right, no, in fact, the close was the lowest intraday low during yesterday's session. So that was actually a very weak sentiment. Okay, so like I explained earlier on, despite this so-called reduction in QT tempering, has it led to a potential new impulsive bullish sequence in the US stock market to see brand new fresh all-time high above the current all-time high that was printed in March this year? Based on odds from technical analysis, the answer is no. Why? Okay, let me share you slowly one by one this longer term picture chart. This is a daily chart of the S&P 500. At the bottom over here on your screen, what you see over here, the orange line is a 3 months implied correlation index of the entire S&P 500 stocks. So right now it's coming very close to a relative low level at 19.7. So this low level over here cannot be low for so long, and there is actually a big risk that it will lead to a spike up in the VIX index. So VIX measure implied volatility. So currently the VIX index is at 15.38, which is below the long run average of 18. So given a very low 3-month implied correlation index within the S&P 500 stocks, that could mean revert on the upside, which could potentially lead to a spike up on the CBOE VIX. So if the CBOE VIX starts to clear above 18.05, now it's at 15.36, 18.05 is a long run average. It could lead to further potential downside on the S&P 500. Still recall the S&P 500, in fact, right now is still trading in this ongoing medium-term decline since its all-time high of 28 in March this year. So where is the next support level to watch out for? Definitely for sure is the 4,800 level. S&P 500 yesterday closed is at 5,018. So the 4,800 level correspond to the upward sloping 200-day moving average as well, and as well as the previous swing high, major swing high of 4th of January 2022. So far, right, this decline of the S&P 500, taking into account of the high, the current all-time high in March, all the way down here is only negative 5% so far. All right, negative 5%, 5.5% to be precise. And another element that supports further potential medium-term weakness on the S&P 500 is the breadth, market breadth. So you look at the market breadth at the bottom over here is the percentage of S&P 500 stocks trading above the 50-day moving average. So based on yesterday's closing value, the number of stocks that are trading above the 50-day moving average in terms of percentage is at 38%. And this 38% is the middle part of this range. It hasn't led to a oversold capitulation level of 9.15% and 2%. So every time once it hit this 9.15% and 2% in the past, if you look at the horizontal dotted line on the S&P 500, this is where was it led to a major bullish reversal. All right, over here, and most recently in October last 2022 and early October 2023 last year, once it hit this extreme oversold level. So there is still some more room to go down before hitting this potential capitulation and extreme oversold level at 9.15% and 2%. That means, i.e., the S&P 500 could still shape further potential downside at this level from a medium term and perspective. That means talking about a multi-week to at least to a multi-month horizon, not intraday. Because intraday there could be wild swing here and there, but that we got to look at the hourly chart of the S&P. We're going to share with you all later. And overall technical configuration, this is the weekly RSI. Weekly RSI also still has some more room to go before hitting the oversold region after exiting from its extreme overbought level. So that's give rise to my first support level at 4,800. Then thereafter followed by 4,580 if 4,800 doesn't really holds from here. So far right now, whatever rally has been rejected by the 50-day moving average on this weekly chart on the S&P that I plotted. All right, so that actually explained to us, yes, despite yesterday's Fed tempering of QT, the net impact on the S&P 500 is still bearish, or i.e. the major US stock index is still bearish from the key technical elements that I shared with you earlier based on the intermarket movement on different kind of instrument, not really focusing on the S&P 500, but instrument that have an impact on the S&P 500 is still pointing to a risk of medium-term potential downside sequence on the S&P 500. Okay, so that's for the stock market with regards to yesterday's FOMC ex-post event. And how does it impact the FX market? So FX market was rather wild because of the potential intervention coming from BOJ. So if you look at over here, the FX market, let me share with you all. Okay, where is the FX chart? Yeah, this is the FX market. So this is the 5-day rolling performance of the US dollar against the rest of the other currency. So you look at over here, the dollar yen actually plunges during the close of the US session yesterday right at 4 a.m. before inching back up again. All right, so you could see over here there's a lot of yo-yo movement in the dollar story over here with the risk of the FX, with the risk of the BOJ coming into the market to actually slow down the dollar strength in the yen side of the story. All right, so that's you give rise to what I call this kind of wild whipsaw movement in the FX market yesterday. All right, but overall, can the BOJ totally change the strength of the dollar against the yen? The answer is very they can slow down the pace of the dollar strength against the yen, but can they reverse the medium term to major trend dollar strength against the yen? Unfortunately, the answer is no. Why? Because of fundamental. So let me share with you this little fundamental model that I use to monitor. Is actually the yield spread between the 10-year US Treasury yield and the 10-year JGB yield, and the 2-year yield spread between the 2-year US Treasury note minus of the 2-year JGB yield. Yes, we know that the 2-year JGB yield is actually inching upwards as well, followed by the 10-year. But the yield spread that is most important. Why? Because that will determine the premium between whether the premium of the US Treasury yield over the JGB yield is widening or declining. So if you look at the trend of the 10-year JGB yield minus the 10-year, pardon me, a bit time to say, the trend of the 10-year Treasury minus the 10-year JGB yield spread is still trading in a medium-term ascending trend line channel over here. So indicating to us that the medium-term uptrend is still intact for the yield premium of the US Treasury yield over the 10-year JGB yield to actually potentially move up to the upside over here. And very similar to the shorter term 2-year JGB yield as well. The 2-year Treasury yield minus the 2-year JGB yield is still hovering in this medium-term ascending channel. So still indicating to us that the US 2-year premium will also potentially widen against the 2-year JGB yield. So with these two fundamental factors that are actually still supporting further dollar strength against the JPY, against the yen, that means very unlikely whatever intervention that the BOJ does right now as instructed by the MOF, it may not reverse the medium term and the major trend of the dollar strength against the Japanese yen unless we come into the later part of this year, where November, December, where we start to see a new president. And if the new president is potentially Trump, and Trump, based on his past remarks to the press, he's actually favored of US manufacturer to actually gain a foothold in the global arena. So in order for US manufacturer to gain a foothold, US goods, manufactured goods got to be cheaper, and this is where he may advocate for a weaker dollar policy, but that will only come in later part of this year in November and December. So till now and then, we may still see ongoing dollar strength potential against the Japanese yen from a medium term perspective. That means we're talking about a multi-week to multi-month time horizon. Okay, so that is for the FX space, all right, for the longer term picture. And how does it interestingly impact then out from this, from the FOMC side of the story, and closer to Asia over here, there is potentially China's more stimulus coming into the picture, because on Monday there is actually a political bureau meeting, and it signal the end of the meeting actually signal measures to address unsold home, and also top official announced that this coming July meeting, they were actually planning to chart a long-term economic reform. So that being a message seems to be sending us a very potentially much more stimulus coming into the Chinese economy to address this ongoing deflationary risk spiral in the Chinese economy that is still prevalent. So that actually explains why the Hang Seng Index, which is a proxy of the Chinese economy, is actually outperforming the US major stock indices and the rest of the world in the last 2 weeks. And in fact, right now, the Chinese Hong Kong stock proxy, the Hang Seng Index, is actually shaping a very strong rally. The Hang Seng Index now is up 2.35%, and the higher beta Hang Seng Tech Index is up 4.4%, going against the weakness that was actually seen inflicted on the US stock indices yesterday, all riding on the cocktails of this potential much more forceful stimulus measure that may come into the Chinese economy in the next 2 to 3 months, all right, based on this news flow. And what we could see over here is yesterday oil prices declined and broke below our short-term pivotal support at 80 level. Why? Because yesterday there was this potential ceasefire talks that is gaining grounds in the last few days. And also yesterday's there was actually a very shocking US Treasury, on the US Treasury, the US stockpile drawdown was actually much more than expected, increasing the supply in the US side of the story that actually lead to the downfall, intraday downfall yesterday in West Texas crude oil prices. So where is this thing I want to share with you? It's over here. Uh, Give me a minute. Let me share with you all the stockpile. Where is this stockpile? Yeah, over here. Okay, let me expand the screen. Okay, so this is the stockpile. Okay, EIA crude oil stock change on a weekly basis. This is for the week ending 26th of April. So previously there was a drawdown of negative 6.368 million barrel of oil. But right now the stockpile, instead of drawing down last week, it actually increased dramatically to 7.265 billion. So that abrupt swing of an increase in US oil stockpile as compiled by the EIA agency lead to this potential short-term downside pressure on West Texas oil to break down below the 80 key short-term pivotal support that we highlighted earlier. All right, so that is for the oil side of the story. So overall, this is the key fundamental takeaway that I'll share with you all yesterday, based on yesterday's movement on the US stock market, and based on the US permit, US FOMC meeting and its impact on the FX market, and as well as, most importantly, the major US stock indices. So with that, now immediately let us now take a look at the short-term technical outlook for today on the various cross asset classes. So before we go, let me expand my screen first so that you guys could see. So now let us start with the FX market. All right, so the FX market, we do have a wild movement yesterday, okay, due to the potential earlier BOJ intervention. All right, so this is what will happen. All right, so there's this wild slide of negative 3% on the dollar yen. Okay, right at the close of the US session. Okay, down negative, close to negative 3%. Okay, over here. So still recall that before we went for a Labor Day holiday break, we will have that bearish bias on the dollar yen, hitting that 20-day moving average at 153.70. So that level hit and it did that bullish reversal right at the 20-day moving average, I think, as a support. So with that, we'll be flipping to a short-term bullish bias now on the dollar yen, using 153.70 for sure as a short-term pivotal support level. Slightly above this support level will be this zone over here at 1553/154.70. So as long as 153.70 is not surpassed to the downside, that means there's no hourly close below 153.70, we will have that short-term bullish bias on the dollar yen. First resistance towards for sure will be that sell-off that reacted off yesterday at 157.90. Above 157.90 re-exposes the long-term pivotal resistance at 15960/160.30 level. However, an hourly close below 153.70 will negate this short-term bullish bias to see the continuation of another round of choppy corrective decline, exposing the next support level at 151.60, followed by 150.80, which is so close to the upward sloping 50-day moving average, and this graphical support area over here that was previously 5th of April and 10th of April. Okay, so that's for the dollar yen. Okay, Aussie dollar, very nasty, still sideways move. What we could see over here is that it while swing around the 20, 50, and the 200-day moving average. So what we could see in the Aussie dollar, right, is still being trapped in this very kind of nasty sideways range configuration since 14th of April. So with that, right, I'll be using 65.50 over here. So what is this 65.50? Previously former congestion area that broke down and give rise to this steep sell-off before rebounding yesterday, and right now is also coming kind of failing to break above the 50-day moving average again, right? Try to test that level, and now there's some kind of downside pressure coming back into the level very closely to the 65.50 short-term pivotal resistance. And this 65.50 short-term pivotal resistance, taking into account of the last push down, was also close to the 61.8 Fibo retracement as well. All right. So as long as this 65.50 short-term pivotal resistance holds, we will have a short-term bearish bias within its complex range configuration. First support level to watch will be close to the 20-day moving average at 65 figure level, also psychological. A break below this level exposes 64.60, which is also close to last Wednesday minor swing low before the FOMC meeting. All right, over here. However, an hourly close above 65.50 will revive this potential push up scenario again within its complex range configuration to see it hover near the upper limit of the range at 65.85, followed by 66.10, which is this descending trend line resistance in place since 8th of March. So that's for the Aussie dollar, flipping to a short-term bearish bias within a complex range configurations. Then European currency, so the euro dollar actually came down below that 1.740 short-term pivotal resistance that we're highlighting at the start of this week, came down before rebounding back up again. So no change, still hovering within this kind of rangy configuration, still using 0.740 as a short-term pivotal resistance level to maintain the short-term bearish bias within its range configuration. First support level to watch is yesterday's level here. Look at this congestion level. Okay, this sell off and bounce off. 1.0690, a break below 1.0690 re-exposes 1.0640, which is close to last Wednesday minor swing low before FOMC, and also the minor ascending trend line support that I drew from 17th of April. Only an hourly close above 1.0740 will negate this bearish tone to see a continuation of this counter trend rebound scenario to unfold. Next resistance that it may get exposed to will be at 1.08T, 50-day moving average, followed by the 200-day moving average, I think as a resistance as well. Then followed by 1.0850, which is the medium-term descending channel upper limit that is in place since December 2023, at 1.0850 level. Sterling dollar also reacted off closely the 125.70 short-term pivotal resistance, which is the close to the 200-day moving average as well. So still no change, still maintain that short-term bearish bias on the sterling dollar. Next support level to watch will be at 12460 within this complex range configuration. Only a break below 12460 may expose the next near-term support at 12390. However, an hourly close above 12570 will negate or invalidate this short-term bearish bias to see a squeeze up for the continuation of this minor counter trend rebound scenario to extend. Next resistance that it may expose at 12640, followed by 12710, which is the medium minor swing high area of 9th of April and 11th of April. So that's pretty sum up for the FX market. So it's a rather a mixed bag picture. We do see dollar weakness coming into the euro, the sterling, and to some degree the Aussie dollar, but dollar strength potentially pushing up against the Japanese yen. Okay, major stock indices. Let us start with the Hang Seng. So let us explain to you Hang Seng strong push up over here. Okay, so right now it almost hit the resistance level already at 18,030 level. Okay, so with that, right, we got to be mindful again. So RSI is really at the overbought zone. So with that, potentially for today, we got to flip to a neutrality stance because it's coming close to this important resistance level that is at least on the shorter term from 12th of October to 15th of November. All right, and given that the RSI also at the overbought region on the hourly time frame. Okay, so with that, this will be my neutral level. Okay, so let me highlight for you a proper one as we talk. All right, so this is the upper neutrality limit, 18,350. Okay, above 18,350 potentially exposes the next resistance level, would be this level here. Okay, this area here at 18,800. All right, now let's go back to the hourly chart. Since we already sort out the neutrality zone, okay, 18,350. Okay, this one remove, okay, remove. So this is no longer the pivot. Okay, so what we have over here, okay, so this will be the lower limit for today. Yesterday's Tuesday's congestion level, before it came down, retested, and it broke out over here right now in today's Asia session. Okay, so for sure this will be like a pullback, former resistance turns minor pullback support. Okay, 17,830. Okay, so for today, the Hong Kong 33 Hang Seng Index neutral because it's almost hitting the resistance level that we highlighted since the start of this week with our bullish bias intact earlier on. And given that the RSI now has starts to flip, the RSI now has starts to hit the overbought region, and also now banking off from a parallel resistance over here that I drew at the overbought region. So there could be limited upside potential at this juncture. So on the short-term basis, like a stress again, this is a short-term technical outlook on the hourly chart. So turning to a short-term neutrality bias between 18,350 and 17,830 on the Hong Kong 33 index, i.e. Hang Seng index for today. Now, next will be the Japan 225. So no change on the Japan 225. Continue to be negatively reacted off its downward sloping 20-day moving average. Came down, almost hit the first support level at 37,680 that we have in our earlier bearish bias. So no change. I don't want to put it so tight. So this will be kind of my first resistance level. Okay, 38,430. So I don't put it so tight at 38,430, still using 38,800 as my short-term pivotal resistance, also conversing with the medium-term descending trend line from its previous high of 22nd of March. So as long as 38,800 short-term pivotal resistance holds, we will still maintain that short-term bearish outlook on the Japan 225, i.e. Nikkei 225, within this very kind of a minor range configuration as well that is in place since 22nd of April. First support level to watch, again, no change at 37,680. A breakdown 37,680 exposes 37,070. Hourly close above 38,800 will invalidate this short-term bearish bias to see a transformation of a counter trend rebound scenario to unfold. Next resistance that it may expose to will be at 39,130, followed by 39,480 on the Japan 225, i.e. Nikkei 225. German 30. Okay, so the German 30 slide down as expected from 18,310, hitting 18,020 level, which is our short-term support level that we highlighted on Tuesday before our May day break. So with the hourly RSI now at the oversold region, there could be a potentially minor counter trend bounce. Counter trend bounce potentially back to retest the 20-day moving average, I think as a resistance level at around 18,060, 18,100. But I will use a slightly higher level, this is a kind of a congestion level over here. And if we do the Fibo retracement, taking into account of this ongoing minor slide, is at the 61.8 Fibo retracement level as well at 18,150. So any potential bounce due to the risk of RSI at the oversold region that don't surpass 18,150, we will still maintain that this will be the tighten short-term pivotal resistance that we have for today on the German 30 DAX index over here. So with that, right, using 18,150 as my tighten short-term pivotal resistance, any bounce that don't surpass 18,150, we will still maintain that short-term bearish bias. Next support level to watch for sure will be at 17,900 / 17,840. A breakdown below this level exposes the swing low area of 19th of April at 17,550. Only an hourly close back above 18,150 will see the bounce to be extended to retest the minor swing high of 24th of April and 29th April at 18,310. Above it exposes 18,400, 18,490. Okay, so i.e. still maintain that short-term bearish bias with a tightened key short-term pivotal resistance for today at 18,150 on the German 30 index, i.e. the German DAX. US Wall Street 30, i.e. Dow Jones Industrial Average, exactly bang off from the 20-day moving average, acting as a resistance at 38,400 level, but I don't put it so tight at 38,400. Still maintain 38,590, very clear graphical congestion area over here. So as long as any potential bounce didn't surpass 38,520, still maintain that short-term bearish bias on the US Wall Street 30. First support level to watch for sure will be the yesterday's minor swing low that confluence with the minor swing low of last Friday at 37,750. A breakdown below 37,750 exposes 37,390 next, which is the minor swing low area of 19th of April. Only an hourly close above 38,590 will transform into a minor counter trend rebound scenario for the next resistance to come in at 39,050. All right. Nasdaq 100 yesterday managed to came down and broke below the neutrality range that we highlighted earlier. So we will flip to a bearish bias below 17,720 level, which is close to the 20-day moving average as well. So as long as 17,720 level holds, we will flip to a bearish bias on the Nasdaq 100. First support level to watch will be at 17,185. A break below it exposes the minor swing low of 19th of April and 22nd of April, conversing at 17,030. However, hourly close above 17,720 will negate this bearish tone to see another round of choppy up move. Rebound scenario 17,810 level will be the next level to watch. So this is a very clear bearish reaction level, reacted off from 17th of April and also last week as well. They can't break above it. A push up above 17,810 will extend that minor counter trend rebound scenario to retest the 50-day moving average, also acting as a graphical resistance at 17,890 / 17,965. All right, so net overall, we still see bearish bias technically in the shorter term from the major stock indices, with the Hang Seng Index, the Hong Kong 33, hitting that resistance level in the short term at 18,350. Then we were flipping to a neutrality stance for today on the Hong Kong 33 index. Now, going for will be XAU/USD, will be the oil. Not oil, gold, pardon me, a bit of tongue twisting, XAU/USD gold. So spot gold managed to came back up and trade above the 2,300 level again. So due to the fact that the Federal Reserve chairman press conference is not as hawkish as fear, so that could actually give rise to a bit of short-term support that's being seen on gold price. All right, because that means, i.e., we're talking about the Fed is not hiking rates soon back again, so that is a very low probability. So holding gold tends to be does not have an increase in opportunity cost, because the Fed next step is not to hike interest rate for now. All right, at least in the short term horizon for this year. So 2,265 short-term pivotal support level, which is this congestion area here. So as long as this 2,265 short-term pivotal support holds, still has that short-term bullish bias for gold. So the first support level to watch will be around at the 2,300 level. Okay, this level here, 2,300, but don't put it so tight, just in case on the whipsaw. So using 2,265. So as long as 2,265 short-term pivotal support holds, potentially we could see a bit of recovery coming back into spot gold. First resistance got to surpass for sure will be at 2,365, formerly the congestion area here, and also right now this minor descending trend line resistance that I drew from the high of 12th of April, within this potential kind of a minor bullish descending wedge configuration that is unfolding in spot gold on the hourly chart. A breakup above 2,365 will add a bit of more bullish impulses to retest the 12th of April and 19th of April minor swing high area at 2,420. All right. However, a breakdown below 2,265 will invalidate this short-term recovery bias scenario to see the extension of this corrective decline sequence to unfold. Next support level to watch will be at 2,035/2,210. This is the medium-term pivotal support area over here, which is the 50-day moving average, also I think coming to act as a support as well. Then for WTI crude oil, so WTI crude oil over here, very interesting, is now coming down to the medium-term pivotal support level. So if you look at the, if you look at the daily chart over here, it's now testing the lower limit of this medium-term ascending channel that I drew from 13th of December low over here. Okay, so it's coming very close to the 78.40 level, which is this former very clear congestion area. Reacted, break, then after that pull back, and that's where the last medium term rally took shape from 78.40, retested all the way up to the high of 87.80 level in April before this corrective decline scenario unfold. So given yesterday near jet reaction because of that increase in the US weekly stockpile from negative to positive, the price came down drastically. But with that, it is now back at the 70, coming back close to the 78.40 medium-term pivotal support, very close to this level. I do not want to be bearish bias anymore because a very little push down, only a mid left, and also there is a slight bullish divergence that's being unfold on the hourly RSI, indicating to us that yesterday's push down is a bit overextended. With that, I'll be having that short-term recovery bias scenario, or short-term recovery bias for today, as long as 78.40 medium-term pivotal support holds. Intermediate resistance to watch for this short-term recovery bias scenario to unfold will be at 80.80, followed by 81.50. Okay, so that's in the short term. All right. However, a breakdown below 78.40 will invalidate this short-term recovery scenario to see the extension of this corrective decline to unfold. Next support level to watch 76.90, followed by 75.50 level. Okay, this support area over here that I drew. Okay, so that's for West Texas oil because it's coming very close to 78.40, and with the bullish divergence being flashed on the hourly RSI, we will be potentially having that short-term recovery bias scenario as long as 78.40 medium-term pivotal support holds for on the West Texas crude oil. Then so that's pretty much sum up for the short-term technical outlook for today on the cross asset, the broad-based cross asset classes. So before we go, let's take a look at the economic calendar. What are the things to look out for today? Okay, so in terms of calendar over here at 1 p.m. we do have Japanese confidence data. So market is expecting a slight uptick from 39.5 in March to 39.7. So if you look at the longer term picture of the Japanese consumer confidence data, okay, it's still pointing upwards. So you look at the 10-year trend, it's going upward higher and higher, which is actually positive in the long run for the Japanese stock market. But in the short term, we still do expect a bit of that corrective decline scenario to unfold, as we explained earlier, as I shared with you earlier on the short-term technical outlook chart on the Nikkei 225 or the Japan 225. Okay, then after the Japan Consumer Confidence Index at 1 p.m., in Europe over here will be pretty much quiet. US, we do have that balance of trade data at 8:30 p.m. Singapore time. Then thereafter, we'll have a rather quiet session in the US as well. And going forward, over here on the earnings front. So on the earnings front, we do have a key earnings to look out for will be Apple. Apple will release their earnings result at the close of the US session today. That means right after 4 a.m. Singapore time tomorrow. All right. Early Friday. So the market consensus is not that fantastic. So market is expecting 1.50 EPS per share for this quarter, slightly above a year ago at 1.52. So market participants will be more concerned about the guidance offered by Apple senior management on whether there will be this ongoing rumored deal with either ChatGPT or Google to actually power Apple phone with AI capabilities. So that's something to look out for as well during the close after the close of the US session, pardon me. So with that, that's pretty much sum up today's daily dose of market insights. Thank you for your time, and I hope wish you a great day ahead, and we shall speak again tomorrow. Thank you.